What if I told you that the global economy, everything from your home loan to the price of your groceries, runs on money that doesn't actually exist? That every dollar in your bank account was born as someone else's debt, and that the system requires us to stay in debt just to survive. It's a system built on infinite credit, a financial illusion so vast, so normalized, that even the experts can't fully explain where the real value comes from anymore. But here's the hidden cost. Every expansion of credit, every bailout, every stimulus check carries a silent price, one that doesn't show up on your receipt, your tax bill, or your paycheck. This is the story of how infinite credit became the foundation of modern civilization, and how that same system is quietly devouring itself from within. To understand how we got here, we need to go back, not decades, but centuries, to the moment money stopped being real. In the early days of trade, money had one simple purpose: to represent real value: gold, silver, land, labor. If you held a coin, it was the wealth. But as trade expanded, carrying gold across oceans became risky and slow. Enter the goldsmiths, the first bankers. They issued paper receipts for the gold people deposited with them. Soon, those receipts began to circulate as money. It was a convenience until the goldsmiths realized something. Not everyone would come back for their gold at once. So they started issuing more paper receipts than the gold they actually held. And just like that, the first form of credit-based money was born, money created from nothing but confidence. This was the seed of a system that would one day grow into the global financial network we live in today. A network that runs not on gold or goods, but on promises. Fast forward to the 20th century. Wars, depressions, and industrial revolutions reshape economies across the globe. Governments needed a way to fund massive projects fast. But there was a problem. Real money, gold-backed money, was limited. You could only create as much as you had reserves for. So, in 1913, the United States created the Federal Reserve, a central bank that could issue money backed not by gold, but by debt. When the government needed money, it could simply borrow it, and the Fed would create new dollars backed by that debt. The gold standard still existed, but it was hanging by a thread. By 1971, President Richard Nixon cut that thread entirely. The dollar was no longer tied to gold, it was tied to nothing. From that moment on, money became purely conceptual, a unit of trust, enforced by law and belief. Governments could print as much as they wanted. Banks could lend as much as they could justify. And credit, infinite, elastic, self-replicating credit, became the heartbeat of the modern world. At first, it seemed like a miracle. Economies boomed. Homes, cars, and businesses were financed into existence. But there was a catch, a mathematical flaw built into the system. When banks create money through loans, they create principal, but not the interest owed on that money. That means the system always requires more money than actually exists. To keep it going, someone, somewhere, must always borrow more. It's like trying to fill a bucket with a hole in it. The moment credit stops expanding, the system begins to implode. That's exactly what happened in 2008. The global financial system was drowning in toxic debt. Mortgage-backed securities, derivatives, leverage on leverage. When borrowers began to default, the illusion collapsed. Banks that had been worth billions were suddenly bankrupt. Stock markets crashed, governments panicked, and what did they do to fix it? They created even more credit. Bailouts, quantitative easing, near-zero interest rates. In other words, the system was saved by doing more of what caused the collapse in the first place. From 2008 onward, the world entered a new era, one of permanent stimulus and invisible inflation. Central banks flooded markets with liquidity, buying bonds, stocks, and even mortgages. Money became so cheap that debt felt meaningless. Governments could spend trillions without consequence, or so it seemed, but the cost didn't disappear. It just shifted. The hidden cost of infinite credit is measured in the erosion of purchasing power, the widening of inequality, and the distortion of markets. When new money enters the system, it doesn't reach everyone equally. It flows first to those closest to the source, big banks, corporations, asset holders. By the time it trickles down to ordinary people, prices have already risen. The result: the rich get richer, the poor get poorer, and the middle class drowns in debt. In 1980, $1 bought what would cost over $3 today. Housing prices have skyrocketed, wages have stagnated, and young generations are forced to finance their futures on borrowed time, literally. And yet, every attempt to fix the system, every stimulus, every rate cut, only deepens the dependency. Today, global debt exceeds $300 trillion, 3 times the world's total GDP. That means for every dollar of real goods and services produced, $3 of debt exist to support it. The system is mathematically unsustainable. But it can't stop, because stopping means collapse. It's a paradox. The system must keep expanding, even though expansion guarantees its eventual implosion. And this is where we are today, in a world where credit isn't just a tool of growth. It's a requirement for survival. Stock markets depend on stimulus. Governments depend on borrowing. Consumers depend on credit cards. The illusion continues, not because it's stable, but because everyone is too invested in pretending it is. So what's the hidden cost of infinite credit? It's not just inflation, it's control. A world built on debt is a world where ownership becomes an illusion. Your home, your car, your education, they're all financed. Even nations themselves are trapped in cycles of repayment, beholden to the invisible hand of creditors. The more we borrow, the less we own, and the less freedom we truly have. Debt becomes not just an economic instrument, but a social one, a quiet mechanism of obedience. Because when you owe everything, you can't afford to question the system that keeps you in debt. Conclusion: 3 takeaways plus call to action. 22 o'clock. to 24 o'clock. So what can we learn from this? Takeaway 1. Money is no longer a measure of value. It's a measure of confidence. When that confidence breaks, so does the illusion. Takeaway 2. Every economic boom fueled by credit guarantees a bust. It's not bad luck, it's math. Takeaway 3. True wealth isn't in printed money, but in real assets, skills, resources, and independence from the system's debt cycle. The hidden cost of infinite credit isn't just financial, it's psychological. It's the normalization of dependency. So the next time you hear about a new stimulus, a debt ceiling raise, or a liquidity injection, remember, none of it is free. Someone always pays the price. The only question is, will it be us, or the system itself? Pause. Fade out with dramatic score. If you found this video eye-opening, share it. The more people understand how our money really works, the harder it becomes for illusion to survive. Subscribe for more deep dives into the history of money, global debt, and the forces shaping our financial reality. Because knowledge, real knowledge, is the only currency that can't be inflated.